Hello, everyone. As you might notice, I've got a new voice. It feels very refreshing. If you miss the old Bob, I'm sure that my surgeon can make it come back. Let's get started with today's video. Yesterday, the European market surged significantly in the morning, with France leading the way as their CAC 40 index rose by around 3% shortly after the opening. The reason behind the rise is the result of the French election. To begin with, we can say that the market generally hates uncertainty, and uncertainty has been prevalent since Macron called for new elections following their extremely poor results in the EU elections. The French CAC 40 closed at the day's low levels, rising by plus 1% for the day. In the S&P 500, breadth was particularly weak yesterday. It was more or less only the tech companies that performed strongly. At the top, we had Tesla, which was up 6%, and Apple, which closed plus 2.9%. When it comes to breadth, I personally like to look at the percentage of stocks above MA20 indicator. Yesterday, it fell from 50% down to 38%, which means that only 38% of the stocks in the S&P 500 are above their MA20. I have to say this is unusually weak breadth, considering that the S&P 500 is hovering around its all-time highs. To believe in even more upside, I want to see the breadth in the index improve. Technically, I like how Apple looks at the moment. Since its last move to the upside, the stock has consolidated over the past few weeks. A breakout to the upside would be worth buying, in my opinion. In the dip buying portfolio, there was one change yesterday as AH hit its stop loss. Otherwise, the portfolio performed poorly yesterday with weak breadth in the USA. Now there is room for one new position in the portfolio, and as it stands, it looks like Norwegian Tomra will be added after the stock made a good reversal yesterday. However, I chose not to add it yesterday as I would like a bit more confirmation of a turnaround, so it might be added today. Roaring Kitty, also known as Keith Gill, who most of you recognize as the man who started the whole GameStop frenzy, made news again yesterday. Keith has made an incredible amount of money from his stock trading over the past 4 years, with the majority of his gains obviously coming from GameStop. But now it looks like he's looking for new opportunities. In his SEC 13G filing, it is clear that he has bought 6.6% of the pet company Chewy, a neat little position of about 9 million shares worth $300 million. In his SEC 13G filing, Keith also states that he is not a cat. This is an important detail. Chewy is actually a stock I've been looking at a bit. I own both the Finnish Musti Group and the Swedish Swedencare. Keith is undoubtedly a skilled investor, but one must also say that he had a bit of luck and landed in a perfect storm when it comes to his position in GameStop. But I'm actually interested in hearing his take on Chewy, if it is something he will share in the future. Chewy is the largest e-commerce retailer for pet care in the USA. The company generates about $11.3 billion in revenue and has had an average revenue and profit growth of 18% over the past 5 years. The company has very thin profit margins of about 0.5%, which makes it look very expensive with its PE ratio of 143. However, the company has communicated that they will focus on improving profitability moving forward, which could be exciting. In the latest quarterly report, the profit margin was 2.3%, which is much higher than the company's previous margins of around 0.5%. If we believe the estimates, Chewy is expected to continue increasing its profitability, and then the company will quickly look much cheaper, at least much cheaper than a PE of 143. I think it feels like an interesting stock to follow going forward. Chewy was up as much as 20% in the pre-market, but quickly fell back as the opening approached. The stock closed down minus 6.6% for the day. Another news item worth highlighting from yesterday is the delivery numbers from the Chinese electric vehicle manufacturers. XPeng increased deliveries by 24% in June, Li Auto by 46.7%, NIO by 100%, and BYD by 35%. What stands out the most is the enormous difference between the Chinese manufacturers and their European and American counterparts, who have instead had extremely weak numbers over the past year. Is it just the weaker economy that has caused problems for European and American electric vehicle manufacturers, or are they also losing market share to Chinese players? These numbers resulted in a strong rally for the electric vehicle manufacturers yesterday. If we are to believe Reuters, Chinese competition is certainly a factor in the weak numbers that Tesla, among others, has delivered recently. According to estimates, Tesla's deliveries are expected to decline by minus 3.7% in June compared to the same period last year. Tesla's delivery numbers are expected to be presented later today. The market does not seem to be worried about potentially weak delivery numbers today. Instead, the stock rose by 6% yesterday and is now up to what I consider to be a key level. A consolidation above $209 would be seen as positive for further upside in the stock. Now that we have entered a new month, it is always interesting to look at the historical seasonal pattern for the stock market. The graph and data below are based on the last 20 years of history for the S&P 500. July is generally a strong month, and the average return has been 2.3%, making July the strongest month of the year. The win rate is also high at 75%. The largest recorded increase during the month is 9.1%, which occurred in 2022. The largest recorded decline is a mere negative 3.4% in 2004. As I usually say, seasonal patterns are just seasonal patterns and do not necessarily mean that July will be the strongest month again. But I think it is interesting to at least keep the seasonal pattern in mind. South Korea, home to memory giants Samsung and SK Hynix, presented their export figures for June. Semiconductor exports grew by a whopping 51% compared to the same period last year. So far, everything points to the memory companies continuing to have very strong momentum. Speaking of SK Hynix, the company has planned to invest $74.6 billion over the next 5 years to expand its AI chip production. This was confirmed at their annual general meeting at the end of June. SK Hynix is far from alone in spending enormous sums of money on AI. It is a trend among all major tech companies. Amazon plans to spend $100 billion over the next 10 years on data centers, and we see this pattern among all tech giants. It costs to stay on top. Considering these grand plans, it doesn't seem entirely unreasonable to continue owning picks and shovels, aka companies that enable this technology development. I'm mainly thinking of companies like TSM, ASML, other equipment manufacturers, energy companies, and so on. Looking at today's macroeconomic focus, it's on CPI figures from the Eurozone. Inflation is expected to come in at 2.5% year-on-year compared to last month's 2.6%. In the afternoon, Fed's Powell will be giving a speech. As usual, when it is not an official Fed meeting, there is rarely anything new said. However, it can still create some volatility in the market. Half an hour after Powell takes the stage, the JOLTS job openings report will be released. That's it for today's market update. Don't forget to subscribe to not miss out on the next one. I wish you luck on the markets today.